Welcome to Disruptive Successor, a show for next generation leaders in family businesses and entrepreneurs who want to disrupt the status quo and take their existing business to a whole new level. We all know that what got us here isn't going to get us there. This show will provide inspiration, advice, and resources to help you create massive impact. Hi, Jonathan Goldhill here, your host of the Disruptive Successor Podcast, a show where we feature advisors and family business owners. So this is a show by, for, and about family businesses. And today I have a very special guest. His name is Jeff Gould, and he is the principal and founder of Lineage Asset Advisors, which is a full-service real estate advisory and asset management firm based here in Los Angeles. Jeff specializes in working with multi-generational real estate families to align their real estate portfolios with their values. He takes a holistic approach to real estate planning and works as a trusted advisor with other estate planning advisors. He has a number of degrees. They are mostly in the real estate area, but he's a certified commercial investment manager, a certified property manager, and a leadership in energy and environmental design, which is the LEED certification. So today we're going to talk a little bit about some of the trends that he's seeing, which are building modernization strategies, wealth transfer and advanced planning strategies with real estate, legacy properties, and symbolic connections to these assets. So let's start off. Thanks, first of all, and welcome you, Jeff.
Thank you for having me, Jonathan. Really appreciate it.
Okay.
Congrats on the podcast.
Yeah, it's great to have you. And so we were just talking about the 5 transition strategies in real estate planning. Tell us, what are those 5 transition strategies? They may be obvious to some, maybe not to others. And let's talk about some of the types of clients that you work with, the stories, and how they tie in with these strategies. So
yeah, we'll dive in. Well, thank you again for having me. My work, I've been in the real estate services industry, predominantly working for the large service firms for about 16, 17 years. And over the course of, in the history of my work, I tend to work with private families, private equity, family offices, and operating companies who, own and manage and operate out of real estate. And it tends to be commercial real estate. So my clientele is usually middle market families who own, anywhere from one valuable asset all the way up to, 15 or 20 valuable assets, predominantly here in California. And yeah, I mean, the profile of client is usually, multi-generational real estate families that are in transition with their portfolios. And what I mean by transition is, mom or dad over the course of, a period of time, it could be, 10 years, it could be 40 years, have accumulated a pretty significant portfolio of real estate. And, over that course of time, they built this incredible portfolio of real estate. And, most of the time, they have, established an operating infrastructure of some sort or outsourced their operating infrastructure. And now they're in a period of transition with their real estate portfolios. And so we help them develop a transition plan with the next generation, because oftentimes the next generation, the kids or the beneficiaries, maybe aren't even interested in real estate, or maybe they have an interest, but they need to be educated, or perhaps the operating infrastructure is not necessarily established. So we are at that inflection point, and we tend to deal with families that where there is a kind of a conflict point, or a point of challenge as it relates to the transition. Real estate is a tangible asset that has a lot of variables, and so what I like to call our firm is similar to how a financial planning firm establishes a long-term plan with liquid assets. We establish that plan with tangible assets like real estate that have the high variability. So yeah, we are seeing a number of trends with families that have owned portfolios of assets for many years. And I guess we can go into those trends if that would be helpful, and we can talk about some of the.
Yeah, let's understand. So let's first start out with just some really basic stuff, maybe before we get to that. So a lot of my clients are younger family businesses. There's only maybe 2 generations involved, and they're just at the point where they're starting to think about buying real estate. Maybe they have a landscaping, a roofing, a plumbing company. They need a yard, and they start to think like, this would probably be a good investment. So what are some just basic things that they should think about in terms of the purchase, the holding of those properties?
Yeah, so that's a good question, Jonathan. So, essentially, the profile of client that I tend to work with has, there's two types. There's the purely real estate family, or, who has accumulated and acquired real estate for the purpose of investment. And then what you're referring to is sort of the operating companies. These are companies that have, over the course of their history, have accumulated assets that they also occupy those properties. And these are companies that have mindfully established the strategy that, hey, we're not only a landscape company or a light manufacturing company, we actually are investing in our future by acquiring the real estate that we actually occupy as well. And so, a lot of these companies actually, and where we stand today with a lot of these companies is the actual business tends to be, maybe filtering out, or maybe they're looking at an M&A strategy to dispose of the business, and the real estate is sort of the golden goose at the end of the rainbow. And so a lot of these companies have essentially accumulated, the principals have accumulated their wealth through real estate, and all of a sudden they find themselves in a very advantageous position. So I would say, as far as real estate strategy and growth strategy for operating companies, I think it's critical to understand, okay, are we a company that is going to grow as it relates to locations? So are we more like retail oriented, or, sub-market oriented? And if we are more sub-market oriented, where does it make sense to grow, and what is our growth strategy from that standpoint? And that will translate to our real estate strategy. A lot of my clients, they have accumulated real estate vis-a-vis, SBA or Small Business Administration loans over the course of many years. With 10% down, and have occupied that real estate as a separate entity from the actual LLC that owns the real estate. So I think that's a critical strategy that many of these companies have employed. I have seen some deficient planning in that space, where a lot of these companies, older companies. In fact, I have one client and a few clients who have acquired, back 50 years ago, assets in an S corp, or in a corporation that is a part of the operating company. And I think what's critical for these companies, if they want to grow, they have to look at the real estate strategy as separate, but equal to the growth strategy with the operating company. And I think these are critical things to think about. So we talk a lot about, what are your needs from a real estate standpoint? We look at things like lease versus buy scenarios to look at different submarkets and understand, hey, if we have a low interest rate environment, it might make more sense for us to acquire versus lease some of these facilities. And so I think, it's a case-by-case basis. It depends on the type of business that we're talking about. It depends on the growth strategy. But I think for a lot of my clients, it's been an incredibly advantageous strategy for them.
So let me ask you a basic question. It may be a dumb question, but maybe it goes unasked, which is real estate, commercial real estate, is it almost always a good investment? Or is it almost always a good investment in California? Maybe those are two different questions.
I'd love to give you a blanket answer, but I can't quite give you a blanket answer on that. I think that each case is very specific to that particular operating company or that particular family. It's specific to what we like to do with our clients is look at things like risk profile. With a family that owns real estate, and with a family that is transitioning, or a company that is transitioning real estate to the next generation, the risk profile of the first generation may be different than the risk profile of the next generation. And so I think that we have to be mindful of things like underwriting, of things like what our needs are. What are we actually acquiring real estate for? Are we acquiring it for cash flow? Are we acquiring it for appreciation? Are we acquiring it for, value and wealth creation? So there's a lot of different reasons why we acquire real estate. And I think taking a step back and establishing or pre-establishing our goals and our key performance indicators and how that relates to our wealth picture with our liquid assets, all of those things are really critical for these families. So I would say, in today's market, we have, you can bifurcate the types of assets in the commercial real estate space. So right now, obviously with COVID, we're having, asset classes like retail, or office or, hospitality, there's incredible implications with COVID and long-term implications. Now, that may lead to incredible investment opportunities, but these clients have to be willing to take on some level of risk and have to be willing to have to absorb that risk over a period of time. And so it really is case by case basis. I mean, the darling asset class in today's market, with everything going on in e-commerce and all of that stuff, is industrial real estate. And multifamily tends to be a good asset class as well, but you have to be really cognizant of the markets that you're investing in.
Okay, so obviously you're quite an expert in this area. Let's get into some of these transition strategies. Tell us, you've worked with multi-generational families, and they're passing from one generation to the next, the real estate. I guess, are there issues with the succession, the transfer? First of all, is there resistance of the older family members to the younger family members, or is everyone aggressively looking to, like, let's get wealth out of our estate? I mean, is that first and foremost an issue? And yeah, I mean, supposing the parents doesn't think the kids are all that responsible or going to do the right thing. I mean, tell us a little bit about what you've seen in this area.
Sure. Yeah, it's a unique area, and I toe the line between, you have to be a conscientious observer of these things. The transfer of wealth can be a sensitive issue, and particularly with real estate, because in many cases, there's a lot of attachment for these families to these pieces of real estate. And I'll get into a little bit about what I call legacy properties. Mm-hmm. So, the transition of real estate is a unique transition for a lot of these families. Like I'm talking about the idea of attachment and the transition planning strategies that are necessary to establish a really positive transition or productive transition, I think are critical here. And what I'm referring to, number one, these are things that are common sense and very, kind of easy to grasp at a high level, but much harder when you start talking about family dynamics and the dynamics of ownership of real estate. So for instance, number one would be communication and education, right? We have multi-generational families where the patriarch or matriarch, for instance, have accumulated, in one case, multiple multifamily properties over the course of many generations. You're talking about, 2 generations and probably 20 to 30 assets. And there's high variability in that. And mom and dad have managed those assets in a certain way for a certain period of time. And they've had their own goals and their own key performance indicators and all of those things in the way they view the portfolio. Now, that may be very different from how the next generation views the portfolio. And in many instances, this idea of communication and education becomes critical at an early stage. You want to get ahead of this. You want to talk to your beneficiaries and your kids about management of these assets. You want to talk to them about their interest level. You want to talk to them to see what their goals are with the portfolio, if they have any, and start to bring them into the fold and educate them as early and as often as possible, so that, in some cases, I've had clients where the patriarch or matriarch has passed away or has become incapacitated, and they hadn't communicated that strategy. And all of a sudden they may have done some estate planning, but they left this portfolio of highly variable real estate to the next generation with no plan and seemingly no communication. And that tends to lead to a lot of conflict. And so I like to talk about, again, it's very obvious, but communication and education at an early stage in the conversation becomes critical. The next one is conflict resolution and accepting differences. Again, we've got, especially as it relates to what you do, Jonathan, succession planning, we have to work through conflict. We have to work through the concept that, me as a patriarch or a matriarch may have a very different view about what happens with the real estate, and our risk profile may be highly different. And if we don't manage that through, if we don't have honest conversations with the next generation and be willing to have that conflict conversation in a respectful way, and accept the differences within the family dynamics, I think it's really critical. I've been involved in multiple situations, particularly one relatively recently with an asset in Southern California, was a highly valuable piece of real estate, and we had multiple generations that owned a tenant in common stake in a particular asset with little respect for one another and no operating agreement and really no path forward to overcome conflict and overcome the disrespect that they had for one another. So I think, establishing a process for conflict resolution, sometimes that that is built into the operating agreement. Other times that's built into the tenant in common agreement. So I think that's another obvious point, but an important point.
Good. Okay. Tell us another one now. We've got the third transition strategy that.
Transition planning strategy. So rediscovering your commercial real estate portfolio. So what I mean by that is, just as if you were to engage a financial planner in the discussion about your, stocks, bonds, and mutual funds, like your portfolio of liquid assets, to, look at the asset class, what you own, and see how it relates to your current goals. Things change over time. And especially with real estate, I find that a lot of my clients, in particular one recently who has acquired many different types of assets through 1031 exchanges, across multiple different property types in multiple different markets. And essentially from their vantage point, it was a great diversification strategy. Well, we're coming to a point where they're realizing, hey, we don't have a capacity. We don't want to be such active managers of real estate. What do we actually have here? What do we have? Do we really have a diversified set of real estate, or do we have assets that really don't meet our needs today, tomorrow, and over time? And I think that concept of rediscovering your real estate portfolio, that's what we do is look at where the real estate portfolio stands relative to their goals. We help them establish their goals. I call it the discovery or rediscovery process. And things like return on equity or value appreciation. What's important to the client? What's also important to the next generation? And then how are they operating the portfolio? And then how do we develop a plan to move that forward, or to maybe reimagine what the portfolio looks like long-term? So I think that's a really critical aspect of planning with these families. And I do think that, because the market is changing rapidly, a lot of my clients who have bought properties over the course of the past 50 years, they really haven't done a benchmark of their portfolio over time. So
do you find that some of the younger family members that come in are now looking at asset classes outside of real estate? Their interest may be in investing in operating companies, equities, hedge funds, private equity firms. I mean, the family office, as I understand it, is an organism that invests in many different classes of assets, real estate just being one of them. Do you find this tension that goes on? And, are these things that sometimes you're negotiating in a boardroom around what's in their best interest?
I think that all of those are really great points. And I think that what you have here is you have a situation where, you've got this portfolio of real estate. And in one case, having a portfolio that had a lot of deferred maintenance in the portfolio. And for instance, these were properties that had been carried forward for 50 plus years. And the mindset of the first generation was, I'm going to essentially allow, these are great, well-located properties. I'm going to allow the appreciation to continue to happen. And I'm going to do nothing essentially and just benefit from it. And so now we're entering a phase with families like that, where the deferred maintenance is coming to roost on the portfolio, and it's having implications on cash flow. Obviously with COVID, it's having significant implications as well. And so the next generation is stepping in and saying, okay, is this really what we want to own? And if it is what we want to own, do we want to now look at a reinvestment strategy that includes investing capital improvements back in these portfolios of real estate, taking debt on, whereas debt might not have been a solution that a lot of these families in the first generation would have contemplated. Now this next generation is saying, hey, we're willing to take on some debt and reinvest back in the portfolio because the opportunity cost is high of not doing that. Right. Or we're willing to take out some debt on this portfolio and reinvest in another asset class. Maybe reinvest in, like you said, maybe angel investment in tech company or something along those lines. So the other thing is that a lot of the next generation is mindful of where we're going with modernization. And so getting to the point of modernization, a lot of these older pieces of real estate, the real estate market is now adapting very quickly. And if you're a real estate owner who is not adapting to the change in technology, the change in sustainability, the change in the change in mentality towards operating these buildings and providing the resources to your tenants, then you're going to lose your tenants. You're going to lose value. And so,
Right.
So I think that hopefully that answers your question on
Yeah,
that.
no, I was thinking, wouldn't it be interesting if they could do 1031 real estate exchanges with other asset classes? Wouldn't that be novel?
It would, but we're not going to give tax advice on that because that's not a possible strategy.
No, I guess not.
So,
all right, so let's talk about the landscape of Los Angeles to switch gears here a little bit. So, having lived in Los Angeles now since 1985, so it's like 35 years, I have seen and met many people who have accumulated and wealth in real estate, having met many CPAs in this town and asking them, so what kind of clients do you have? Do you work with small businesses? Do you work with middle market business, family companies? And the vast majority, like 90%, work with people who primarily own real estate. And it just seems that LA, I don't know if this is unique to Los Angeles, but real estate is such a significant portion of the wealth in this town. And then there's a whole group of people that, maybe CPAs and others that work with those in the entertainment industry and have made money off that. I find a very small group of CPAs that just deal with businesses, light manufacturing, whatever the type of business they are. Mm-hmm. So talk to us a little bit about, who are some of the families in this town that come to mind as very real estate rich, very prominent and well-known, and, are multi-generational type families? Yeah,
I mean, there's a lot of case studies of that. I mean, just to take a step back, I think Los Angeles is one of those towns that, has historically been a, family-owned real estate town. And what I say by that is, you compare this town or you compare California for all intents and purposes, as almost like a state that has, agriculture and families that have built their wealth through agricultural land and all of those types of things. LA is a market that has evolved in that way, multi-generational real estate families. Some of these other markets like New York and these other areas, that they're very institutional by nature. And I think that we are seeing a transition now to more institutional real estate in Los Angeles. It's becoming more of an institutional city. But you do have these very historic properties, these very historic families that have, for all intents and purposes, owned real estate for multiple generations, like the Amundsen family, or the family that owns the Helms Bakery property. I mean, you have a number of families that own, prominent hotels in the city of Los Angeles. You've got, Hollywood-based families. You have, guys like, Dick Simon and folks in Los Angeles who have built incredible portfolios of real estate in Hollywood and in other markets. So I think that, it is a town that I like to, I liken it to, what I call legacy properties. These are properties that have transitioned over multiple generations that are highly symbolic and relate to the family for which have owned them for multiple generations in a very clear way. And so, there are many cases of that. And what's interesting about Los Angeles is it's such a diverse town. We are experiencing something very interesting with COVID, where we have seen, a flight out of the city in some respects, but still, I mean, you've got a project like the Sunset Gower Studios, where they just, Hudson Pacific just sold a $1 billion+ stake in the Sunset Gower Studios and the studios around it that they own, which was a 50% interest. So there's an incredible amount of movement of capital and movement of family office money in a market like this.
Gotcha. So you have this LEED designation, and what's the significance of that to the work that you do or to the clients that you work with?
Yeah. So it goes back to the concept of modernization. And, when I first got into the business, I've always been interested in the impact of real estate on the environment, the implications, the consumption of energy and water within our built environment, and our stewardship of managing and operating these buildings in a more efficient way. And I think that, over the course of my career, I was on the board of directors for the U.S. Green Building Council Los Angeles chapter. I've been involved in nonprofits. I'm a managing director for a program in Los Angeles that works with building owners in the city to help them look at efficiency, energy and water efficiency. And so what it comes down to is, it comes down to efficiency. It comes down to modernization. It comes down to what you would, as a business coach or as a coach of a company that is trying to operate in today's environment, an operating company, they want to operate as efficiently as possible. And real estate owners want to do the same thing. So as it relates to energy efficiency, for instance, it's a cost factor. If you can reduce your energy costs, and you can not only contribute more to the environment by doing that, but you can also save utility costs in the process. Same with water, and this is across the board. So matching the efficiency side of things with the renewable side of things. So things like solar and wind and fuel cells and all of these other things. This is where the evolution of where our buildings are going, is not being energy consumers, but rather being energy generators. So we call it, net zero or, net positive, even is where our built environment is going. And the opportunity in Los Angeles is huge because, the built environment is very, like, the age of our building stock is incredibly old, and so how do we evolve within Los Angeles? We have a unique opportunity.
Well, and we certainly have the sunshine, and we know we have the water's kind of expensive and is precious. So it does seem to me that the lead the folks that are leaning into having lead buildings, it's a more of a mindset that they're focused on sustainability, and maybe they lead with a pro-environmental philosophy and mindset, and we're dragging along the rest of the people, and some of them are really late to the game, when it should be a no-brainer.
It's interesting, Jonathan. I think if you follow the flow of capital right now in the institutional real estate space, we have designations or certifications, one called GRESB, which, basically a lot of these pension funds are now really focused on environmental, social governance within their portfolios of investments. And so, even if you're not an environmental proponent, I should say, being focused on where the flow of capital is going, not only in the real estate space, but also in the institutional space, when investment advisors are proposing to clients, they're talking about ESG, environmental, social governance, what companies are really at the forefront of that concept. I think that we're going to start seeing really a lot more of this. And like you said, it's going to bring by nature the market along with it. So. Yeah.
Well, one thing I've not really spoken to anyone about, and I'm not even sure this is something in your area of expertise, but these opportunity zones that came I guess, a couple of years ago as a great investment opportunity. And it seems like it's an investment opportunity mostly for the wealthy, but you must be dealing with people who have assets that maybe are wanting to have more assets in those particular zones. Can you tell us a little bit about what those are?
Yeah. In fact, I just completed a project in an opportunity zone. I mean, I think the concept itself is good. It's sound. The merits of it are good. Where the heart of the program and what it's trying to accomplish, which is establishing an infusion of investment into some of these environmentally economically disadvantaged markets, is really sound. I think the challenge with it is that with COVID, we have obviously what opportunity zones are. Just to take a step back, it's a tax advantage strategy for investors to basically do away with some of their capital gains, or remove some capital gain burden on some of their investments, and so they can take, for all intents and purposes, a stock and liquidate that stock and then invest it in an opportunity zone and get capital gains benefits across a 10-year period, over a 10-year hold within that investment. And so there are some really significant implications for investors. I think the challenge is that with COVID, we have a very specific timeline with the opportunity zones, and that with COVID, a lot of people, didn't liquidate assets because, quite honestly, there weren't any capital gains to liquidate. And so the market timing is very interesting. And we also didn't see that flow of capital yet because the program it's a bit clunky and it's a bit hard to understand. And there's a lot of moving pieces with it. And you really, what I say is, I don't like the multi-asset opportunity fund, investments. What I like more of is the, single asset syndicated deals that have a very clear path where you can clearly underwrite the implications of the real estate, this piece of real estate itself, because there's a lot of timing and other moving pieces with this fund.
Well, obviously, you can see Jeff Gould is an expert on all things real estate, and this man is passionate about what he does. And his name, his company's name, Lineage Asset Advisors. It really seems to speak very well to what you do, Jeff. So kudos to you. I've always enjoyed our relationship as we've only known each other for a short while and met a few times, but very impressed with what you do. And people can reach you through your email. Is that the best way?
Yeah, email is fine. Jeff at lineageasset.com. You see the website up there in this beautiful background that I just literally chose before we got on this call.
Almost looks like Los Angeles, except there's no river like that going through.
No river going through downtown
LA. So,
yeah.
All right. Well, thanks, Jeff, for being on the show. Hopefully, folks, you found this interesting, and you'll know where to reach out to Jeff if you're thinking about dealing with real estate assets or you're looking for some more insight. You heard it here on the Disruptive Successor Podcast. Thank you very much. Thank you for joining us on the Disruptive Successor Podcast. If you enjoyed today's episode, please subscribe, review, and share with a friend who would benefit from the message. If you're interested in picking up a copy of my book, Disruptive Successor, go to disruptivesuccessor.com.